Hey, what's up guys? Welcome back to the channel. So today I wanted to talk to you all about how trading stocks actually works and how you can use it to make money. So one thing I've found is that on videos in YouTube, there's a lot of people who cover, dividends investing or index funds or things like this, but there aren't many videos that cover the very basics of what a stock is, how a stock actually works, and how you can use it to make money. So I thought I'd make a quick video about that for you guys. So the first thing to understand is what a stock actually is, or what one share is equal to. So essentially, a company's current value or market value is subdivided into a certain number of shares, and this is done at the start of a company's creation. So say a company is worth £10 million and they have 10 million shares, then each individual share is worth £1. So the total of these shares basically indicates the current market valuation. So this valuation is what's referred to as the price of a share. So the price is what a seller is willing to sell at and what a buyer is willing to buy at. And this basically determines the current exact point market value of a company. Now this is very different to another attribute which is often referred to, which is value. So the value of a share is actually how much it's worth through a combination of tangible and intangible factors. So these are things such as revenue, profits, income, but also more intangible things such as public perception and the future goals of the company. So those two key terms are something that I'll keep referring back to, the value and the price of a stock, because those are really how you make your money. So there are three key ways that you can make money with trading stocks. The first is marginal gains, so this is typically what's done by a day trader, where you trade on very quick markets and you make your profits in 15 minutes or in a day, and you trade for very small margins, but your margins add up over time. Then you have what's referred to as value stocks, so this is where you try to identify stocks where the value of the share is greater than the current price of the share. These you hold for a slightly longer period of time. They can be long-term holds as well, up to 30, 40 years. But this is essentially where you buy into a company when you think the price is low for what the actual value of the company should be. And finally, there's dividends. So dividends are a slightly separate topic, which I will make my own video on, but very quickly, they are essentially a reward given to you by a company, which is a percentage of the share price that you buy in at, for you being loyal to the company and having faith in them. So circling back to the three different ways you can make money. So marginal gains, as I said, this is done by day traders, and these are on very volatile markets. So these are trading stocks which are subject to very quick and sudden swings. So what this allows you to do is leverage that quick change to turn a very quick profit. However, you're also exposed to a very high level of risk, which is why the majority of people who trade on day trading and these kind of things actually end up making a loss or do incur significant losses along their way, even if they are profitable in the long run. Then you have value stocks. So value stocks, essentially your money is made before you even buy the stock. So the whole thing with value stocks is doing your research beforehand and identifying a stock which is under market value at the moment for the price it's being sold at. So what I mean here is that, say for example, a stock is trading at £100 per share, but you've done your research and you think that the company is heading in a good direction and that actually their profitability is more significant than £100 per share, and they could be trading more at £150 or £200 per share. Then by buying that share at the lower price at the current market value, you then have done the research and the work beforehand, so once that stock eventually increases in value, that's when you take your profit. So value stocks offer a slightly lower risk than marginal gains because they're not in such volatile markets and they tend to be with slightly more well-known companies. You don't tend to find as many value stocks with very quick startups. However, there is of course never no risk in the stock market, and so you could end up losing your money if you made a poor decision about a company or if a company underperforms. And finally, of course, there was the third type of way of making money, which was dividends, which, as I said, is essentially a reward paid out for you owning a stock or backing a company and giving your support to them in the form of buying their shares. Now, the benefits of a dividends investment is that the actual dividend itself tends to be a relatively good recurring payment, which most companies that offer dividends tend to not default on. And you can actually look up the payment history of a company to see whether they default on their payments of dividends or whether their dividends tend to increase or decrease with time, which is really good because it means before making your investment, you can actually look into a company and decide whether they're worth investing in as to whether their dividend payout is regular or not. The other benefit you have with dividends, of course, is that it's not just the dividend payout that you get, but also if the stock increases with value, then the shares that you hold will increase with value. So you also make some additional money through that. So then we come to how you can use stock to your benefit. Now there's multiple different ways that you can benefit from stocks, and these are basically through different brokerages. There are brokeraging apps and brokeraging firms which allow you to buy stocks directly of your own picking. There's also different types of funds. For example, a mutual fund, where a fund manager will pick the stocks for you, you just put your money in and they take a commission. Or there's an index fund, which is a pre-selected number of stocks, which you just put your money in and it automatically takes that money and invests it in a certain spread of stocks. So the first type, the brokerage fund, essentially you can use things like Trading 212, Etoro, or any online famous brokerage that you might have heard of before. The benefit of using Etoro and Trading 212 is that there's no commission when you are buying and selling your stocks, which is really good because it reduces the costs if you're just getting invested with a small amount of money. Next, you have your mutual funds. So of course, these you can get invested in just by looking up companies that offer mutual funds like AJ Bell or Hargreaves Lansdown. But these funds are very typical. Essentially, you pay for a wealth manager to choose the stocks that you invest in, and they'll take a commission based off how much you invest, or a fixed commission based on the type of investment that you make. And finally, you have your index funds, which, as I explained, are a fixed group of stocks which you then invest in through a third party, for example Vanguard, who offer very low commission index funds. So in order to establish which one of these things you want to go for, you have to understand what you want to do. So whether your appetite is for picking stocks yourself to try and get the maximum gain, or whether it's through paying somebody else. If you're looking to invest in stocks individually and pick your own stocks, then I'd recommend using Trading 212, as it's a really simple, easy to use platform. The app is really easy to use. It's got loads of detailed metrics, and I'll leave a link down below in the description, which can get you a free stock worth up to £100 if you sign up now. So if you decide to invest with Trading 212 or with another firm where you pick your own stocks, then I'd say that it's important to understand what metrics to look at in order to decide which stocks to invest in. So the first of these is the price to earnings ratio. This is something you'll see in loads of other videos about how to invest, but I thought I'd give my own quick breakdown of what it is and talk to you about how you can calculate it, or even if you need to calculate it at all. So the PtoE ratio is your market value per share divided by your earnings per share. Now that sounds kind of confusing, but actually it's very simple. Your market value per share is the price to buy one share of a company. So say if you go onto Trading 212 and you see a company, for example Tesla, that's trading at $1,500, then you know that one share is $1,500. So that is your market value per share. So then you have the earnings per share. So earnings per share can be trailing or it can be forwards. So what this means is that either it's the earnings per share looking to the future, or it's the earnings per share looking historically into the past. Typically we use earnings per share trailing, so looking into the past, because it's backed up by empirical data and is slightly more obvious and easy to follow. But it might not be quite as applicable, for example, for a company that is rapidly developing, where they don't have a previous 12 months of data and they are growing incredibly quickly. But the easiest way to calculate a trailing earnings per share is to go on Google and to look up investor relations reports for that company. So in an investor relations report, you can find the profits and the losses for that company that you're looking into over the last 12 months or over the last quarter. And what you can then do is you can divide the profits by the total number of shares, which is something that you can Google or that you can look up through Trading 212. So then once you have both those numbers, the market share price and the earnings per share, then what you can do is divide one by the other, and that gives you the E to P ratio. But actually, as I'm about to explain, that's not necessarily something that you need to do, because most of these websites like Trading 212 or Etoro actually offer you the price to earnings ratio immediately available once you look on the app. So I'll put up to my left and to my right screenshots or videos from both Etoro and Trading 212, and I'll show you where you can find the profit to earnings ratios for each. They also provide a bunch of additional information underneath about why you might want to invest in a company and what their overall conclusions about the company are. They also have a bunch of data to do with the profits, the revenue, and all the other expenses that these companies undergo and their R&D investments. So both the apps actually have a tremendous amount of native information to decide which stock you want to invest in. So as I said, the PtoE ratio is therefore provided to you by Trading 212 and by Etoro and by most other brokerage firms if you ask for which stock you're investing in. So do you really need to calculate this? Well, no. It's something that's talked about a lot, but actually just looking at the number is all you need. You just need to understand what the number means and how you can use that to find a good value stock. So typically, a profit to earnings ratio of 15 to 17 is the market average. This is the typical average for companies which are in the S&P 500 index, which is the large index of 504 of some of the biggest companies in the world. And what that index tries to do is it tries to match the performance of the world markets. So that's essentially your average baseline go-to, is a PtoE ratio of 15 to 17. So then anything above that value could be seen as a worthy investment or a company that is undervalued at this point in time, so the price that it's trading at is lower than its value. Now you have to be careful and take this with a pinch of salt, because of course there are certain things which can affect a company's price and a company's share valuation that don't necessarily play into the PtoE equation and could give you the wrong image of how a company is performing. So remember, as I said earlier, that the value of a company is based off intangible and tangible objects. So when you're looking at the PtoE ratio, the PtoE can actually be inflated by some of those tangible things. So for example, if it's projected that a company is going to do really well, for example, Apple during the coronavirus, they've had very good sales, it was projected that they would beat their quarterly estimates. So therefore their PtoE ratio is very high at the moment. In fact, the Apple PtoE ratio is 36.18. But if they are in fact underselling in certain areas, but this isn't widely known, then once their quarterly reports would be released, their stock would plummet in price and you'd end up losing money even though you've invested in something with a strong PtoE ratio. So it's important to be careful and bear in mind that certain things affect the PtoE ratio and can make a stock appear better than it actually is. One way to test this is to look at the historic price of a share and look at it versus its PtoE ratio. So if you look at a share at the moment and it's got a PtoE ratio of say 30 and above, then that may look like a very good investment. But if you look at their current share price versus their historical share price, their current share price may be significantly higher than that stock has ever traded before. At this point, that means that you need to do further research to identify why that share price might be so high at the moment, and whether it's caused by a short-term gain, for example tech companies doing fantastically well during coronavirus because people can't go out and shop on the high street, or whether it's caused by a longer-term gain, for example whether a company's hired a new CEO, or whether they've had a change in strategy that's really working for them. Similarly, this works both ways. If you find a company with a really low PtoE ratio at the moment, but that has historically traded at a much higher share price, then that could be a good stock to buy. For example, you could look in and you could see whether that company has lots of capital and lots of revenue behind them, and lots of historical data, which means that they will be able to pull through the coronavirus situation. For example, there are lots of major banks at the moment whose stock prices and share prices are at the absolute lowest that they've ever been. But some of these banks may in fact have the capital to ride through the coronavirus wave, and so there is a lot of profit that could be made in those situations if these companies pull through. I want to add a final legal disclaimer, which is just to say that I'm not a financial advisor, I'm not a wealth manager, and that if you do want to make any investments based off of this video, then you need to seek financial consultation and legal consultation beforehand, and that I'm not held liable for any investments you make based on this video. But I thought I'd just make this video as some brief introduction to how shares work and how you can make money from them. So now that the boring legal disclaimer is out the way, I just want to give you a final overview of everything I've said today. So there are 3 different ways that you can make money with trading stocks. There are marginal gains, there's value stocks, and then there's dividends, which I'll do a video about so that you can find out more about that. And essentially, I just wanted to summarise the different ways that you can get involved. So you can get involved with Trading 212, Etoro, different brokerage firms which you can find online which are easily Googleable, and then index funds and mutual funds. If you did want to use Trading 212, check out the link down in the description for a free stock worth up to £100 when you sign up. And my final recommendation would actually be something that's a bit counterintuitive to what most people say. So most people will advise you that when you start investing, diversifying your funds is really important. So that is spreading your wealth across as many different companies as you can, across a bunch of different market sectors, to ensure that you don't take too many losses in one place. But actually, I think when you're starting off and picking your first few stocks, you should stick to what you know and think about what you're investing in. So I'd recommend picking a field or a subject area that you know lots about, whether it's your career field or whether it's something that you have a hobby in and you're very passionate about. Something that you know a lot about the different workings of different companies or the different workings of the actual market itself and what might be trending in the market in the near future. Then do your research into different companies within that market and how they might be progressing or how their research and development might line up with what you think is going to be valuable in the future, and identify 1 or 2 companies within that field that you think are undervalued, where the stock price is lower than what you think the value of the company really should be. Once you've identified those two, then I'd say invest in those. Now, of course, your shares might go down, you might make the wrong decision, but that process of learning how to research different companies and identifying what shares are actually worth investing in is something that I think is far more valuable than just diversifying your funds straight away just because someone said you should do and because it's the lowest risk option to take. So that's everything I've got to say about stocks really. I hope you did enjoy the video. If you did, please leave a like down below. Please also hit the subscribe button if you're new around here, and leave me a comment with what you think was the most useful piece of advice and what you might want to hear a video on in future. I'm always open to ideas. Thank you very much for watching, and I'll see you in the next video.